The results are in for this week's Trader Sentiment Survey report, and let's just say they're pretty mind-blowing. But with $5 trillion at stake in triple witching, what else do we need to know coming into this Friday? And what sectors should we really be focused on as the equal weight starts pumping up? We know that the Dow is making all-time highs and the Nasdaq and S&P 500 are not so far behind it. But with these things going parabolic, it's pretty hard to get involved in them unless you're just buying every single rip. So are there other sectors that need to be focused on? And more importantly, do we need to be looking at this chart? Yes, the hottest stocks and the biggest of 2023 are now the laggards. The Magnificent Seven is failing to make new highs. So should we be really looking at this chart a little bit more closely moving forward? Well, welcome back, everyone. My name's Tom. Today, we're talking about everything to do with markets, and we've been running this show for over 3+ years with daily content. So if you're interested in anything to do with markets, remember to subscribe and smash that like button. Much appreciated. It always helps. So let's get into everything that happened over the last 24 hours. First up, semiconductors did well, and energy came back with a big boom, including some laggards, which we've been talking about on this channel in previous sessions. The Mag 7, though, that did not fare so well. Microsoft, one of my favorite stocks, down 2.25%. And you can see here in the rotation, it was a pretty big switch. Solar, clean energy, and home builders and construction were really hot. And of course, everyone's now talking about regional banks breaking out in a big way. So could this still be part of a huge rotation that leads us to more parabolic trends? We'll talk about that when we get onto the charts, but you can see here the last 5 days have now been solidly overtaken by some of the worst sector rotations that we've had over the last year. Yes, the most hated stocks are now the most loved, according to the market over the last couple of days. Just a reminder as well, we have a new weekly newsletter coming out this weekend, so make sure to subscribe to that if you want to. It's totally free in the links in the description down below. So let's talk sentiment survey. I said these results would blow your mind. Let's talk stats here. What do retail traders think generally over the next 6 months? 51.3% responded as they were bullish, the highest reading since July of this year. We all know what happened a few weeks after that. We also had another massive reading, and this one's huge. The lowest bearish reading in 6 years. Yes, you heard that right. In 6 years, the lowest bearish reading. And when you take a look at options and also the cost of options, it will make some sense. But let's talk about some of the readings going on right now and why you can't pay too much attention necessarily to things such as this one here. The S&P 500 breadth percentage of stocks with RSI above 70, no doubt it's insane. 48% of stocks are now above 70 in one of the most overbought markets in over a decade. But does that mean it has to stop right now? Well, let's look at some of the evidence. First up, where are we going this OPEX? Well, we still have that 4,700 pin that we discussed. Obviously, there are 4,800 pins as well. But really, the 4,700 pin seems to be the biggest gravitation for this week's $1 trillion expiration. It's kind of where we find ourselves at the time of this recording as well for the market. So it may want to just gravitate here, and then next week we'll find out whether it's willing to push a little bit higher. Because it's hard to stop a freight train. We'll talk about that later on. Retail is also pumping it up in terms of the amount of options traded. And you can see that by this time, the data is probably updated here. We're getting close to all-time highs over the last couple of years. So that's going to be a big deal. And of course, something we need to be paying attention to. So I mentioned before that parabolic advances usually go further than you think, but they do not correct by going sideways. This usually means that because we've now entered into a parabolic trend as of Tuesday and Wednesday, which really was, of course, the FOMC speech from Jerome Powell and how wild the market went after that, we're entered into the twilight zone. So these markets can pump a fair bit, but when they come off, they will be fairly brutal. So do expect the VIX to be spiking at some point over the next weeks into months when eventually this trend does break. In terms of performance, I thought I'd just bring this in anyway because we've been talking about it. Obviously, these are the stats. The stats are not necessarily working out at the start of this December. The pullback happened early, but it wasn't that much of a pullback. And now we've been ripping thanks to all of these interest rates. But there's what happens generally over OPEX in terms of plus, minus, and all of the days around it. We also know that revisions earning will be something that you want to look at in 2024. And I will keep bringing this up because really, Wall Street will eventually work out what's going on with earnings. And if earnings don't meet the criteria of the market, do expect the market overall to sell. And that's going to be, of course, one of the discussions here. Growth stocks typically fare best when economic growth is modest, what we call a deflationary boom. Now, if we're in a deflationary boom, expect 2024 to be pretty good for growth stocks. And again, value may be behind it. But for now, it's all been about rotation, and we will look at those soon. We can also see as well, coming out from Goldman Sachs here, that it looks like hedge funds, or at least US equity funds, were purchasing macro products pretty heavily over the last week, and they went back into buying the market after being net sellers notably for a little period of time there. So they were selling for a few weeks and then they've gone in hard. Are they having to hit this market to try to get some window dressing or something before the end of the year so they can say to their customers, hey, we made some money, don't worry, we didn't miss out on this rally? It's possible, and of course that could be one of the reasons we are rallying so hard, along with just the exceptional amount of calls that we've seen go into the markets. We'll talk about that soon. Small caps versus large caps. We mentioned this on the December the 11th to February the 11th. We tend to see outperformance of small caps. In 2 days since then, we've done 6 to 7%. So we've almost done all of the 8% normal average in 2 days. Can it hold up though? Well, it is possible, because if you have a look at this read as well, with the massive amount of call options that have been coming out for the Russell 2000, it's really not necessarily a bad sign. I mean, in previous times when we've got these types of reads that are really high, markets have actually gone on rip runs for the Russell 2000. Something I'd keep in the back of my mind. We also do know that seasonality usually comes through here. Like we said, from December 11th to February the 11th, we tend to see the strongest run for the Russell 2000. And so far, it's smashed into 2 resistance points, including hitting one of the big take profit targets, being the 2000 number over the last 24 hours. Let's talk about Fed dot plots, because of course this is what everyone's discussing now. Now, what the Fed thinks and what's probably going to happen are going to be completely different. I would always say that these future positions based on interest rates have generally been wrong. You can pretty much prove that from 2022 to 23, the market's gone up, down, and all around, predicting 7 in total pivots and finally getting one right after 7 times. But yeah, this is what the current dot and pivot dot plot are saying. So the market basically says, hey, we're going to see a lot more cuts. And the Fed's saying, well, we think we're going to give you about 3. What about S&P 500 4-year cycling? Well, it does turn out that usually 2024, which is the election year, would have a positive correlation with it. But do remember that this comes in normal years. Now, we are most likely either going into a soft landing situation or the hard landing situation. And those will be decided generally around the first Fed cut. We also will see US 2-year at some point come underneath the US 10-year. So we will see uninversion of yield. That's actually when you should be most terrified of the market. And we've been very consistent by talking about that, because that's when we're going to see the real price action that will tell us whether we're getting the soft landing, which I actually would rather get because it's better than a hard landing really for everybody's families, or the hard landing, which is going to show some negative moves on the markets. That's going to be something that's interesting for 2024. And it's going to make markets, I think, quite volatile. And again, a pretty good trading year. Here are some of the laggards in terms of what's not been doing well up until recently. So you can really see that this is where the opportunity rises if we continue to see rotation through this market. And I'm not going to forget about the Grinch stat. I think this is a big one. 3 days before plus 3 days after Christmas. This is something that we will be tracking moving forward. So make sure to stay tuned for that one as well. This is what happens during options expiration week. 73.2% of the time we are bullish during the week. So far, that has been absolutely true. Of course, way higher than these percentages, and 75.6% the week after. So theoretically, this rally could run based on stats alone. Mag 7 as percentage of total US single stock net exposure. As we know, funds have been dumping the Mag 7 across the board as they've rotated into other sector markets. We saw this on the charts. We had a suspicion it was happening. And of course, we've so far been proven correct because the RSP is playing catch up. That's the equal weighted market. Another one for anybody that's looking at markets outside of the US, here's an interesting thing. Moody's downgraded, of course, China and Hong Kong recently. And when they've done that in the past, the results have not been necessarily negative the next year. In fact, they've all been positive. We've already read these out several times, so I'll leave it at that. Let's go through some big transactions. Now, we just got a monster transaction coming in from TLT. Not only was this previous support, but then we hit into it after a massive rally in yields. Now, I'm a big fan of treasuries moving forward into 2024. I did obviously think there could have been a little bit of a sell here based on the supply, but then Jerome Powell really didn't scare the market, which actually I thought he might have just said something slightly negative, but he basically didn't at all. He just let this market rally up. And then we hit into, of course, the number one trade. Could that be a sell? It's possible. But I still think treasuries, whatever pullbacks they do bring in, are most likely going to be met by bull demand. So pullback is possible for treasuries based on that huge sell at the key resistance. What about equal weighted market? Well, we just saw a massive dark pool transaction. Now, I'd have to say that's most likely some type of profit target. You can see a huge trade down here and a huge trade down here, some of the biggest in history. And those have, I would say, started to say, well, you know what, this was a pretty good run. We hit some take profit areas and maybe they have started to reduce in what is an epic rally. It doesn't mean it has to fall straight away though, but I want to talk options and unusual activity. Let me just go down here. I was preparing this before we were shooting the video and I was like, whoa, total trading options value, 60 million, normal 39, 60. That's a huge session. 64% calls as well. That's just massive. And it was one of the biggest trade sessions I've seen in quite some time. Retail, 26% of the single legs. And you can see here the unusual options volume was pretty much across the board. We had big moves on solar. That was one of the best sectors. First solar coming through, one that a few members of our Market Masters Club was certainly heavy on. Obviously, we've been talking about Enphase here. And there were just so many really huge moves through some of these sectors. I mean, Enphase did 11.7 on a 1.9 times average volume. I also noticed Moderna came in hard at 9.2% this morning at 2.82% in terms of average 90-day volume. So there were some big trades. What was probably most interesting is we continued to be relatively flat in terms of Qs, and also the S&P 500 went super bullish. So look at this, super bullish, 6.13 versus 4.39. And take a look at the Russell, almost a 2-to-1 from the call to the put ratio. Some big deals there. Same type of thing happening also on Tesla, I noticed, and Tesla broke out of a coiled range. So could it be time for Tesla to actually start its little run here on the markets and start to play catch up? It seems likely because, of course, it's been doing nothing for some time. Effective yield dropping off, nothing to be concerned about if you are a bull in the markets. That's not really a bad sign. That's a good sign for you. And you can see here that equal weighted markets blew through these highs and continued to make on. Now, that's parabolic for sure, because you can see that these are very, very large, huge standard deviation candles. And this is not just a few up. This is quite a few up now. So we're clearly in a market that's in the twilight zone. That's fine if you're involved in it, and of course you can check it out and look. But the thing, even with the equal weight, now that it's gone like this, is you have to start breaking down sectors. We'll do it soon together. Let's have a look at the bond market. It is super hot. That's looking good. If you're a bull, US 2 versus 10, not even close to uninverting, so that's obviously not a concern. Consumer discretionary versus staples. The American consumer is hot on the markets right now. I mean, what can we say? The US 10-year is getting closer to some demand zones down here. So potentially after we fell through and we had that big move that we talked about, thanks Jerome, then of course we're now moving down to these areas. It's not really sitting in anything I would expect to spike the yields up heavily, but yeah, we'll see whether it can get down there. So again, that's not necessarily bad for bulls out there. And of course, treasuries smashing into what is a huge level, getting closer to the gap fill as well, which would be around $100. So yeah, big trade coming in, big rally. I mean, this is one of the most epic rallies, I guess, on treasuries for a long time. 20% very quickly and huge volumes too. Look at the volumes across the board, just so massive down the bottom. And we've been discussing treasuries a lot. They are pinned to be one of the best investments of 24, but then everybody's talking about it now. It's not really a new thing. PCC dropped off here, so you can see that, of course, calls are starting to get loaded in the system super heavily. And look at home builders. I mean, yeah, it's not bearish, but geez, that's big. ITB, XHB, all of these things just flying, and they're pretty extreme. I mean, they're obviously in parabolic trends, and we'll talk more about that soon. What about central bankers? Well, central bankers were also injecting. I mean, it's It's like a clown show or something. Yeah, we've got central bankers pushing into the markets, going along. This is rallying the markets as well. People are now writing articles about this, so everyone seems to have cottoned on to this one. I would say a little bit too late, but anyway, it started to happen where they're looking at more than just necessarily the the asset kind of tightening sheet, and they're looking at the whole picture. But yeah, that was a big deal. Copper still on the fly here. We saw a pickup over the last 24 hours again, breaking through 3.86. If we get through 3.93, that could be really good for metals, and XME, etc. could be some interesting sectors to look at. But copper also might be a play with oil as well, just to see across the board something that's been a little laggy recently start to play catch up. The US dollar continues to be really weak. This market sector, of course, is horrendous at the moment, and it just smashed straight into this 10158, which is a level I had marked a little while ago in terms of a key zone on the charts. Now, I'm not sure if it will stop here. I mean, it's like catching a freight train. So we'll have to look for structure, and as I say, patience, react, don't predict. But look, Druckenmiller, a few other people do believe the dollar is going to get smashed in 24. And I tend to agree that the dollar is probably in for a little bit of a problem because, of course, if the Fed is forced to rate cut a lot, it's going to make that currency less desirable in comparison to other countries that may not be cutting as much. This will be one of the storylines, and I expect currency to be a relatively good trade in 24 as well. What about gold? Well, gold came up to the supply. It kind of made a slight high and then rejected straight away. From a small time frame perspective, people will be jumping into gold and looking for it to breach below 2027 or 2025 because it can look like a little bit of a head and shoulders here. Obviously, the trend has been down in recent maybe week and a half. So, yeah, I mean, it's possible. And this is a day trade kind of setup that some people will have. Again, everything is only stats and stuff. So you've got to be careful and have your own triggers, etc. Let's talk US oil. So this was a pretty strong comeback here. Look at the weekly now. So that's a weekly, if it does close like this, that's gone down once, it's wick rejected up, and it's gone down again to a new low, and then wick rejected up. If we do close this as a bullish hammer, it could mean that we're stabilizing. And of course, we have seen some sectors, actually a lot of energy stocks were rallying really hard, and they came back super strong. Now, if you know your technicals, you might be able to figure out what that is. And this was actually one I was discussing in my private stream yesterday, and it happened really beautifully. It was a great run. And it just shows you sometimes it's worthwhile looking at the laggards in markets if they provide the right setups. So yeah, energy looking a lot better than it was just a few days ago. Maybe it's starting to get ready. Speaking of getting ready, is Tesla ready to go? Well, it got out of its coil. It obviously closed above any previous close here, and it's above the trend line. Now, it is behind. I mean, if you wanted to put S&P on this, I'm just going to do it here just to prove how far behind it could be against a lot of markets. Let's go out here for a second. And now, percentage-wise, it's going to be really high. But if you think about it, the S&P at the same time that it was at previous highs, we had up here, realistically, more like almost a 300 read. And then obviously we were at like way higher points while the S&P was at the same point. So really, Tesla is super far behind the market. And that doesn't mean it has to go all the way back up to $400 a stock where it kind of would be if it was following the S&P, but it certainly is behind. Some key levels to watch in the future will be something like 274, but that is a fairly strong looking weekly candle if it does close that way. And the daily obviously is coming out. Big options on it as well in terms of the call side. And I can just imagine that people on message boards are starting to get wild on it again. Solar was probably the best sector, or was the best sector of the day, along with clean energy. And again, that's one we spoke about, broke out trend line, been sitting for a little bit, and then it's really putting in some good gains. First TP achieved for some people, and second level would be up there around 56-ish on the charts. Now, the DAX, is it the first index to show signs of weakness? The DAX was one of the most heavily short-sold markets. And over the last 24 hours, and I'll be doing an update after we see the OPEX because I want to see better results here. We had retail trader trades and options, futures markets and CFDs. They went from being so heavily short to getting liquidated. Basically, we went down to around 70% shorts instead of the usual 90% shorts that we've been seeing, which means that these candles here, unfortunately, blew up a lot of retail traders' accounts. Now, that's a doji if you know anything about weeklies, so obviously it's starting to put it in, But as we talk about, it's very difficult to stop a freight train. So generally, it will take a little while, but it won't go sideways for long. So it usually goes bang, 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 that kind of thing. And then you get like these really wild markets at the top with sometimes even super parabolic runs with huge wicks on them. So we'll be looking for those types of signs. Think back to what we saw in Bitcoin recently. That type of market is the one we're looking for. Oil at 129 would be another target to look at, just so you can see what happens in parabolic runs if they do get really wild. This actually put in the first sell that we've seen of any index as well. You can see it made a lower low past this point here, which really signifies the first way that trends can potentially change. And technically, the DAX actually put in the first bear sign that it's done in, 15% or something like that. So I wouldn't be surprised at all for it to go back above 17 and do all sorts of shenanigans to stop it out. This is only the first time frame, and you can see that sometimes, even when you had like things like oil and stuff, they weren't able to hold at the first time. So this is the first weakness. What do you think in the comments down below? Is the DAX done, or has it got more to pump? Let me know. Oz 200 achieved pretty much. This is what we expected from the inverse head and shoulders. Actually, one of the best technicals throughout the indices. And I haven't covered it that much because really nothing changed for our opinions. But that's a beautiful inverse head and shoulders, a beautiful break of the trend line, and technically a great TP zone in terms of technicals. So very nice, and it's approaching a pretty good Christmas period. So there you go. Let's move over to the US 2000. Now, this went on to the new highs here. You can see it rejected a little bit, showing that someone took profit at 2010, which I don't blame them to. I think between 2000 and 2010 is a pretty logical TP zone. And with candles like that, you'd be feeling pretty damn confident. The problem is that candles can get even wilder during these runs. So it is still very possible to see explosive moves that go through these levels, because right now we are in a parabolic movement and they can go for a while. So let's just quickly discuss, do we have any real signs of weakness? I would say not really, because these are just like weird red rejection candles. There's not much structure behind them yet. We haven't even had a chance to make structure. So we're going to have patience, react, don't predict on those types of things. What about the NAS? The NAS also hit into a key critical red box zone near its all-time highs, and then it also saw a bit of a rejection. Again, Friday OPEX will be an interesting one. If we end up pushing to a new high by the weekly close, I'd expect a new all-time high coming through, even if it hadn't done it yet. So that's something to be looking at. And then we come to the S&P. Now, the daily close is a doji. So that means that it's kind of hit a level where it's like, you know what, I'm pretty cool with this. We already spoke about the 4,700 pin. So if the 4,700 is just closed into again, and then it does another doji, that would be perfect for market makers. Then next week, if we breach out, we're probably going to go on to some big levels. And we'll talk about just before 4,800 is a watch zone. So 4,776, something to be watching out for as well. Even an all-time high followed by a sell later on. These are all things that can happen here. Now, we mentioned the MAG 7, so I want to just kind of bring that up again. So obviously, nothing much has changed on the MAG 7. If you've been in MAG 7, it hasn't really been doing very well. You can see here that it had this kind of quick movement up, which is pretty normal. You get that massive gamma stock move. Then it comes down, and then, of course, it comes back up to what would be considered pretty much the sold zone through here. So it's really at resistance. You can see a long leg doji. If it does close underneath this, it could be one of the first signs of weakness in this market. And I think we have to keep a very open mind here. It's not often we see parabolic index runs, especially on the biggest market in the world. And we really haven't seen one of these in a very long time. I was thinking about the other day, and I was thinking, well, have we actually had one of these? And you might say, well, Tom, we've had plenty of them. Look at 2021 and 2022, and with these big rallies. And yes, these rallies were extreme. These were extreme rallies. But I think this one takes the cake because it's not just extreme. It's also moved to larger sized candles than we've ever had in these other runs. Like even over here where we went 7 weeks up, then we went sideways, then we kept grinding. Actually, it's not that one. It's this one over here, 2018. We had that very, very, very strong rally up. It was still relatively small. Then you can see here we got these big moves that were bigger than average. That's the type of thing that we're looking for. Bigger than average moves. And then you can see the type of explosion that happens afterwards. So just remember the quote. Be very careful out there if you are getting involved in everything and you're getting FOMO and let's say you missed the point or whatever, I always say to everyone, practice abundance mindset. You might have been 2 weeks ago chasing the Mag 7. How did that work out? Probably not that great. What about a week ago? Maybe you were chasing some hyper stocks. Well, maybe you missed them, okay? But then just 24 or 48 hours ago, we still had solar, we had clean energy, we had energy sectors, we had so many things. Abundance mindset, I know it just sounds like a word, but let other people know in the comments down below as well if that's helped you. It certainly helped me to be able to understand. It's why we cover so many markets as well on this channel. We don't just cover one, we're covering everything because there are always different opportunities. A few weeks ago, it was gold, then it turned crap. Then we had Bitcoin around that time as well. And then we've had the dollar at certain periods. So you can see there's tons of opportunity, guys. You don't need to jump on the new trend or craze or anything like that. But at the moment, we are in a parabolic market. And that's just the facts. We're not in a standard market. It's pretty wild. And I think it's a great case study as well for everybody to learn. Because even for myself, I've been trading for a long time now. I haven't seen a market in terms of the S&P go like this with these types of ranges. I've seen plenty of other stocks do it. But this will end in a wild way, I'm sure about it. Thank you very much for watching. If you enjoyed today's video, make sure to subscribe. Hit that free VIP, free weekly newsletter. Links in the description down below. And of course, smash the bell. Thank you so much. Bye for now.